and welcome to BloombergQuint. You're watching earnings interaction with Embassy REITs, and joining me is Michael Holland, who is the CEO of Embassy REITs. Michael, welcome to BloombergQuint. To begin with, give me a perspective of how your occupancy rates have moved because since the pre-COVID levels, because we saw it dip and it's gradually coming back to normal. But where are we vis-a-vis pre-COVID levels?
Yeah, I think I'm pleased to say that we're probably now at the bottom or beginning to move up from that bottom. We started pre-COVID around about 94% occupancy. We were 88% last quarter or previous quarter. We're now at about 87%. And we feel that trajectory now will be heading in a positive direction. I think in some respects, the industry feels like it's moving past the COVID pandemic and those discussions. We're encouraged by the quantum of leasing that we saw last quarter, probably the highest number of leases and quantum of leasing done, new leasing in Q3. We did a gross number of 428,000 square feet, a net number of new leases of about 345,000 square feet. Excuse me. We had 8 new occupiers that we signed up. So it really does feel like the trajectory is a positive one, that we may well be leaving the clouds of COVID behind over the coming months. We look at the hiring data for our customers' industries, and it continues to be off the charts. Some commentators talk about 350,000, others talk about in excess of 400,000 new hires in the tech sector. For sure, globally, technology is right at the center of every business globally. And that's feeding through to us. We're seeing demand from multiple different sectors, not just from the traditional IT services, but from banking and finance, from retail, from healthcare, from e-commerce. We did a lease this quarter with an electric vehicle research cell and so on. And we've also seen, interestingly, a number of occupiers who had in the past said to us that they thought that they might be shrinking, actually roll that back and come back to us and say, no, we're now expanding. So I think there were 8 different tenants totaling about 300,000 square feet that said that to us. So there's multiple factors that we're seeing that give us a real positivity about the stage that we're at in the cycle and where we're going. And we think FY23 is going to be a great year in terms of leasing demand.
What about exits and renewals and rental increases? What is the average rental increase which you've been able to garner? I assume that there was some reduction that happened during COVID period. So have we gone back to pre-COVID level rentals and about that?
Well, I think actually, if you look at the data around how rentals have held up through the COVID period, you'll see that many commentators would agree with our analysis that particularly in large demand centers like Bangalore, in high quality properties, rentals have been flat through the COVID period. They neither fell nor did they grow, but we're beginning to see some growth in rentals. In that 425,000 square feet that we did last quarter, we actually saw a 24% spread on old rental payable to the new lease. So we're definitely seeing rental growth in a number of areas. I think the issue is that the best corporates are not here in India, in Bangalore or in Bombay because of low rentals. They're here because of high quality talent in the science and technology sector. And that is becoming more scarce around the world and more in demand. And I'm sure, the comments that are there about wage inflation and attracting and retaining talent. So the thing that's important for our high quality occupiers is the quality of the product that they're being provided with. Is that something that helps them attract and retain the best talent? And one of many factors for us is the whole area around ESG. That's why we've got a big focus on it, because our customers also have that big focus. So there's a number of things that push together and help to keep rentals stable, and we think over the future to grow.
What about diversification of sectors? We have seen actually IT companies talking about different models, hybrid models coming in, and while they are aggressively hiring, we've seen a huge amount of hires happening from top 3 or top 5 IT majors based out of Bangalore and Mumbai. They're looking at new models wherein they don't increase the infra cost, but they have a mix of work from home or or co-working spaces or any of those kind of spaces. But going ahead with that kind of model, are you seeing that in your portfolio? And if that's so, are you seeing new sectors now coming in and taking up those gaps which have been left by them?
Yeah, so I mean, there's multiple things in that just to unpack. So we're definitely seeing demand from multiple new sectors. So that demand might be in terms of healthcare, retail, e-commerce, banking and finance, research and development, pure technology. So different sectors within the demand stack. We're also seeing different levels of demand and different leasing models. The traditional model, which is the majority of our leases, but we're also seeing the flex working model coming in. And that's one of the reasons why, even before the changes that have been brought by the pandemic, we had always said we liked the flex service model. We endeavor to have a flex or co-working type of provider within every one of our business parks. And indeed, we're seeing a number of deals through that within our parks over the last quarter, and we think that will continue. That's a good thing for our business. Their tenants to us, we're still receiving that income, and giving that flexibility to our tenants or to the flex operator allows us to attract, and those tenants grow within our business parks, and ultimately, as long as they remain within our overall ecosystem, that's good for our business.
Mm-hmm. Coming to your operations, your net operating income went up by 30% in the third quarter.
Yeah.
You guided for a higher net operating income as well as distribution per unit. Can you give us an idea what is this confidence based on?
Well, the increase in our NOI guidance is based both on the past quarter in terms of additional new leasing, which, as I said, was the highest quarter in terms of new leasing since before COVID, and also the pipeline that we've got in our hands today for the balance of the year. So we're confident that we'll be able to execute on close to 1 million square feet of new leasing for this financial year. And that, of course, is what feeds through to that increase in 3% increase in guidance, given the fact that we've got just this quarter to run. We've got a good level of confidence. We are also feeling pretty bullish about the balance of the calendar year, so next financial year, FY23. And one of the reasons for that, there's many factors, but one of the reasons is out in the market, there are pan-India, there's RFPs for 30 million square feet of office accommodation. Now, 60% of that RFP demand is in our 4 markets. About 18 million square feet of that RFP demand is in Bangalore alone. So we can see not just in our short-term pipeline, we feel positive and confident. There may have been a slight delay because of this Omicron phase where a lot of people are quarantining. They're actually, not unwell. They're just quarantining at home. That has delayed some elements of business this quarter. We think that will pick up pretty quickly. And the midterm prognosis looks very, very encouraging. We're feeling really, really good about that.
I think some of the decisions been pushed to Q1 because of Omicron.
I think what we're seeing, we would say that it's not that decisions have been pushed to Q1. I think the physical execution of documents has been delayed.
Okay.
So there really hasn't been a change in the principle around whether or not people want and need that space. I mean, I'll give you an interesting. I touched on a different thing where you've got tenants coming back to us and saying, we had thought we were going to shrink, we're not. Can we have that space back? Eight tenants have done that to us, relating to 300,000 square feet. So, all the signals are that companies see that their headcount is growing. They want to get back to the office. There might be a few weeks delay on administratively getting the leases signed, but midterm we feel positive.
What's going to be the guidance for the DPU?
So our guidance, midpoint guidance, has been increased from 21.5 to 21.7 DPU.
Okay, and do you expect to reach the higher end of the DPU guidance, given the kind of scenario which you see?
Well, what we've done is we've narrowed the range. So we both increased the guidance and we reduced the range from a 3.5% range to a 1.5% range. So we're homing in on that number. That's the midpoint number.
Mm-hmm. What about your development pipeline? You have nearly 4.6 million square feet of development pipeline. Yeah. When do you expect that to come into the market and add to your operating income?
So that's covered in quite some detail in the deck, which is on our website. The 4.6 million square feet is spread out over the next 3-4 years. Different buildings coming on stream at different times. We just last quarter delivered 1.1 million square feet to JP Morgan. That was a build to suit at Embassy Tech Village. Later this year, we'll be delivering approximately 800,000 square feet in Pune. We've got new buildings of about 1.9 million square feet that we've started at Embassy Tech Village in Bangalore. We got another 800,000 square feet in Noida that will be coming on stream end of 23, early 24. So it's phased at different times, which again we think is good in terms of timing the market. The other major project that is coming up for completion for us is the hotel project at Manyata. We've got 2 Hilton hotels up there at Manyata. Of course, Manyata is a 120-acre, 12 million square foot office park, and we're putting those hotels and the conferencing center at the front of Manyata. It'll operate from around about May, June of this year. We think that will have a real good synergy with the offices, that the office occupiers will really like the fact that they can have that conferencing center on their business park. They'll like the fact that they've got all the F&B and also, of course, the ability to hold all sorts of events there. And another element, of course, about Manyata is that the hotel being at the front on the ring road, we also anticipate that we'll see some great weekends, trade conferences and weddings and so on and so forth. So it's all part of that complete business ecosystem that we offer.
I was about to come to your hospitality business, but since you touched upon it, how is occupancy looking there? 35%, 37%, I think, in the end of Q3. Where do you see that occupancy up? Do you see it's going to be a slow and gradual jump in occupancy?
Well, the thing that we're very happy about for Q3 is that again was another first in the post-COVID days. That was the first quarter that we were able to show EBITDA positive on the hotel segment. So that was really encouraging, even though we had not yet got back to the point where international business travel was moving along. This few weeks of Omicron in January, February, that clearly is going to have a negative impact, but we think that we will catch up in FY23 on occupancy as travel opens up. We see the hotel piece of the business as ancillary to our offices, supporting our office tenants, supporting those international companies that are coming in and out of India, and we see that as a good long-term ancillary piece of the portfolio. But it is a relatively small piece in terms of our NOI. It's probably less than 1%.
Your expansion strategy is also based on acquisitions from especially your promoters, and you have ROFO on quite a few projects coming up. I think Chennai is one of them which is coming up. How much are you going to spend on that ROFO for Chennai? 5 million square feet, which is coming up?
Yes, so we received that ROFO notice, the right of first offer notice, just this morning. It's an interesting asset. We're excited about it. Chennai is a city that we've always said is one of the top 6 cities that we are interested in. And
you're not there today, right? In Chennai,
we don't have any assets in Chennai, so that's another element that is of interest to us. We've just started our work on looking at that asset, but what we do know, it's a 29-acre site. It has development potential of approximately 5 million square feet. So in the context of our current operating portfolio of about 34 million square feet, that will give you a feel for how it would sit in the portfolio. We understand that there's about 1.4 million square feet is up and operational and leased to a number of top quality international tenants. So we look forward to getting into the due diligence on the property. Then there's another 1.6 million square feet of new development which is underway, and then I think the balance 2 has yet to start. So we're looking at that with great interest. It won't be. It's a year since we did the Tech Village acquisition. That's gone very well for us. We've exceeded our assumptions on underwriting for Tech Village. So now it's a good time to be looking at that market, Chennai, and that asset, which is a great location close to the airport. And once we've done our work, we'll make an announcement about that.
How do you plan to finance it? Will it be purely internal accrual, or are you going to use your debt headroom which is available to you?
Yeah, so we've got some significant debt headroom. Our overall balance sheet has always been very strong. Our bonds are rated AAA. We've got a 24% net debt to TEV. So we're in a great place that we've got a number of different ways that we could finance an acquisition like that. Once we look at the detail around it, we'll make a call on it. But we've got sufficient debt headroom to be able to take something of that nature on.
Will it have any impact on your DPU in any way? Will it reduce given the fact that you're going to go for an acquisition?
I mean, we would look for an acquisition that was positive and accretive to our DPU. so we would want it to have a positive impact. Yeah.
And any timeline for this thing to come through? I mean, by when do you decide on whether you will go and take a pause or leave it?
We will be looking at that over the next 3-4 weeks. It will take a little bit longer than that to conclude if it were to proceed. We'd need to take necessary approvals from the board and so on. But we're certainly looking at that over the next couple of months.
Mm-hmm. And what is the kind of potential revenue that could come in from that asset? What is the market like there in terms of lease rentals? Has it been as good as? Is it as good as Bangalore, or is it a little more challenging there, like Mumbai?
Yeah, I mean, every market has its own levels of sophistication, and there are different locations within sub-markets that perform better or worse than others. I mean, what I would say is we are more by design than by accident. We have the majority of our portfolio is in Bangalore. I think over 72% is in Bangalore. Bangalore is the number one by a country mile office leasing market in the country. Consistently, it's around 30% of leasing on a pan-India basis. So that's a great foundation for our business. We're interested in Chennai because it is a strong technology center. It's strong in the banking and finance sector. It's strong in the automotive sector. So for us, it's really about the quality of that tenant base and the scale of demand. There is no market in the country that comes close to matching the demand side of Bangalore, but Chennai is a significant market, and for that reason, we're certainly attracted by it.
So you expect to close it by the end of this fiscal, basically March 2022?
No, I can't say that definitively. I mean, first we need to assess it. And if we're proceeding, we would want to proceed as quickly as we could. But we need to go through our due diligence and our necessary internal and unit holder approvals. So we're not putting the end of the financial year as a marker that we want to close a deal like that by. We will take the time that's necessary to do the work and to come to the right conclusion for all of our unit holders.
Finally, Michael, your cost of borrowing, last one was 6.5 or 6.6%. Do you see that going up, given that the interest rate cycle is gradually turning around? What kind of hedging have you done so that it doesn't go up beyond 7?
Well, I think I'd look at it almost the other way around. We're in a great place in terms of our cost of debt. Our finance team have just done an absolutely sterling job on that over the last couple of years. At IPO, our cost of finance was somewhere in the order of 9.3%. They brought that average cost down to 6.6%. Most of that debt is on mid fixed terms, so 3-year terms. So we have quite deliberately and strategically done some refinancing exercises, fixed that debt, and so we have a fairly clear line of sight to that competitive cost of debt for quite some time, and we've got a nicely spread out set of repayments over the next 3 to 5 years. We also just recently have done some green bond financing for our rooftop solar project, which is a 98 crore solar project, 20 megawatt solar project, which I believe was done at 5.9. So we're seeing the benefits of our strong ESG strategy feeding through into the cost of that particular debt. And I think again, we're in a strong place on the balance sheet and on the cost of debt, and we don't foresee that being problematic over the coming couple of years at all.
Michael, it's been a pleasure talking to you today. And stay safe. Thank you very much for watching.
Thank you very much, Sajid. Nice to talk to you. Thanks.
Bye.